Hi there, it's Stephen Thomas with Reports on Housing, coming to you with another housing debrief. Thank you so much for joining us. Wanted to bring you up to speed as to what's going on in the housing market right now. Let me tell you, we still have inventory has been climbing, and it's been climbing all year. Typically, we're out of the summer market. We've transitioned to the autumn market. We do that at the end of August. And so typically we find a peak in the inventory during the summertime. And then inventory starts to come down and demand starts to come down. And that's the autumn market. Both of them coming down at similar rates. And then the pace of the market, what we call expected market time, that's the speed of the market. Place your home on the market. When are you becoming a pending sale? And usually that's flat for the remainder of the year. Now, since the end of summer, when we should have already peaked, the inventory kept on going up and demand went down. So as a result, what we've seen is the overall pace of the market continue to slow. But recently, within the last week, we're starting to see signs of the inventory peak coming. So we'll have to wait and see if that's really what happens. But the inventory peak coming and demand not coming down as much as at a fast rate. So we're not getting giant changes in the pace of the market, which is typical for autumn. So we'll have to see if this is how it continues to unfold. But so far, all the markets have really slowed to the point where we are in the middle of September, and this is the slowest September in some markets dating all the way back to 2014 for this time of year. In other markets to 2019, but you have to stretch back a little bit to the last time the housing market was this buyer friendly. So the market is pretty buyer friendly right now. And what that means is there are a lot more choices out there, that homes aren't like being zapped off the market immediately, unless of course it's turnkey, they've done all the right things, but we're building more inventory across the US. So we have more inventory and demand isn't as high. And we have interest rates that have come down to rates that we have not seen since February of 2023. So rates are really good. There are more choices. Really, really good time to be a buyer right now. So let's get into today's episode. Are rates crashing? And the Federal Reserve met, and they had been meeting over the last few days, and then they had their press conference yesterday. And Jerome Powell, the head of the Federal Reserve, made a big announcement and then talked about afterwards. But the big announcement was they had a rate cut of 0.5%. Now, this is the short-term rate. It's a federal funds rate is what they call it. It's a short-term rate. Now, this is not 30-year mortgages, which are tied to real estate. Those move in anticipation of where the Fed will be. Instead, this is short-term rate, credit card debt, automobile loans, as well as equity line of credit. Now, when the Fed cuts rates, those go down instantly. When the federal funds rate is increased, those go up, which is why credit card interest rates are as high as they are, because they were the federal funds rate was as low as 0, and as of before yesterday, they were as high as 5.5%. So big giant change. And they went ahead and did this 0.5% move. Now, the big giant debate was 0.25% or 0.5%. That's pretty much what was up in the air. And if they went 0.25%, they would have had to do a lot of explaining. And don't worry, we're on top of it, and we'll be looking at everything. And it would have sounded a lot like the way that they've sounded almost all year. But they kind of changed a little bit in their language. They did that big aggressive change of 0.5%, which they don't typically do unless there is a real problem in the economy, and there isn't a real problem in the economy. So this big giant change is not reflecting that the economy is totally tanking. They're kind of playing catch up. And that what they were kind of saying, if you read between the lines, is they should have maybe already gone 0.25% back in July, and they're just playing catch up right now. But they're not that worried about the overall economy. That's kind of what the language led us to believe. So they did this 0.5%. And you could see immediately everybody went to all the different sites. Mortgage News Daily I go to on a daily basis to see where rates are at for the day. This is across the United States with no points. What do rates look like? And if you look at this, they actually, I'm pointing to the day, they closed higher for the day. So people were going, oh my gosh, This is that day. This is actually, and then the very next day is today. It went up even higher. So that's why the arrow is where it's at, because the next day, this is today, they went up even higher. What in the world is happening? As a matter of fact, everybody went to Mortgage News Daily. When I went there after the press conference was done and Jerome Powell had finished, walked off the stage, I actually went onto the site and Mortgage News Daily. I couldn't access it. It was a big blank screen. I couldn't access it because everybody's trying to access it at the same time. And they thought rates should really come down. And I actually heard mortgage professionals say that rates should come down. I heard other real estate professionals stated. I heard consumers out there state rates are coming down. And I knew rates weren't going down. As a matter of fact, I was looking at the 10-year Treasury even prior to Jerome Powell speaking, and they were it was already up. And usually when the yields on 10-year Treasury goes up, the interest rates go up for the day. When yields go down, interest rates go down. And the yields go down when the economy is really slowing down, and interest rates come down as well at the same time. That's just the way that investors work. I'm not going to get into the weeds talking to you about that. But everybody was wigging out because all of a sudden they go to their favorite place to look to see what happened to interest rates, and interest rates actually went up for the day, and people were absolutely perplexed. They were beside themselves. But I have to point something out. Now, the federal funds rate, this is the over time, it has been the same since July of 2023, last year, all the way through yesterday. Prior to yesterday, it had not changed. It was what they call, it's between 5.25 and 5.5. It was just stayed there the whole entire time, not changing at all. That's why flat line. During that same time period from July through yesterday, you could see mortgage rates have been all over the place. And what happens there is mortgage rates and the people that invest in them and 10-year treasuries, they go where they think that the Federal Reserve is going to go. So if they think that the Federal Reserve is going to keep rates higher, well, shoot, they're not going to look at long-term issuance of 10-year treasuries and mortgage-backed securities, which are tied to interest rates. So as a result, we had interest rates that have been all over the place. And last year in October, the Federal Reserve was saying, don't worry, you know what? We're not changing this thing at all. We're going to be staying restrictive for a while until we see everything in the data, and it's going to be a while before we make a change. So interest rates, everybody believed them, and that's when all the financial investors out there started to really believe what the Federal Reserve was saying, and that's where interest rates got all the way up to 8% in October. The Federal Reserve didn't even like it. And they started backpedaling because this was too restrictive. And then interest rates started to come down. And then we started to get some cooperation and inflation data and things like that. And we had interest rates that came down even further. And then we began the year, and then things got a little bit, the economy started to do a little bit better than what we thought. There was way too many jobs that were created. And then in the month of, as you see right here, I'm pointing to the month of April, there were 3 times where interest rates hit 7.5%. So that was the height for 2024. And they hit it 3 times during the spring market, probably the worst timing for the market because rates started off the year at 6.37%. Or a little bit above 6.5%, sorry, and they made their way up all the way up to 7.5% because the economy just looked like it was not going to cooperate and it wasn't going to slow down. Then since then, we've actually had the labor market start to cool. We've had revisions in labor data that showed that the labor market had cooled a lot more than anticipated from March of 2022 to from March 2023 to March of 2024. So they redid the numbers. It was cooling a lot more than they anticipated. Inflation was coming down. So as a result, we've seen interest rates come from 7.5% to where they were as of a couple of days ago. They made their way all the way down to 6.11%. Now, 6.11% is pretty darn good. And 6.11% is the strongest rate. It matched a rate that we had a few days prior. And that is the lowest rate going back to February of last year. So that's a long time that we've been sticking with the same rate. So rates were at their most favorable point right prior to the Federal Reserve meeting at 6.11%. Now, Since then, they went up to 6.15 yesterday, and that's when everybody freaked out. Everybody clamored to Mortgage News Daily, and then they made their way to 6.17% today because everybody was still really excited, elated that we came down a half a point, that things are going to be better for the economy based upon everything that Jerome Powell and the head of the Federal Reserve had to say. So as far as rate cutting is concerned, here's the thing that you need to understand. It's already baked into where rates are going to be, or where rates are at today. They are anticipating where the Federal Reserve is going to go based upon everything that they're saying, what they're seeing in the economy. And what they're actually saying is, after listening to what Jerome Powell said yesterday, yeah, you know what? We actually think the economy is going to be a little bit better than what than what we were originally thinking. They seem to think that everything's a little bit better. And I also wanted to point out, so you can see here, this shows you the difference between the federal funds rate and 30-year mortgages. The 30-year mortgage rate is that red line. And you can see how it bounces all over the place. And that blue line is the federal funds rate. And you can see how flat it is, but we have interest rates that vacillate all over the place in anticipation of where they think the Federal Reserve is going to go in the future. And usually when you get a rate cut, what happens, and you can see this over here, this is the most recent time. This is when we started COVID and the federal funds rate was dropped down to 0. And you can see that even though the federal funds rate was dropped down to 0, that interest rates slowly but surely made their way down to further and further down. And they didn't instantaneously that day go down. As a matter of fact, when they were going up, which you see in the middle of the screen, when they were ratcheting that staircase up, a lot of those days, interest rates for the day, 30-year mortgage rates actually went down while the Federal Reserve raised rates because, like I said, it's already baked into the equation. They're going where they think the Federal Reserve is going to go, and then after the Federal Reserve goes, then they say, well, based upon what they're saying, this is where we think they're going to go future. And yesterday was a big day because it wasn't just that they talked about this cut in interest rates. They talked about where they're going to be going in interest rates down the road, which we'll get to in just a moment. So, and I'm going to go back even further, and I'm going to show you that here we are. This is going back even further. This is 2001. And you could see that that the federal funds rate, they had reduced the federal funds rate quite a bit. And it didn't mean that interest rates fell, they dove. They slowly but surely made their way down. So this is just one more example of how it slowly but surely makes its way down, maybe not at the same clip the federal funds rate is coming down. So you have to understand, you just have to look at everything as far as the 10-year Treasury is kind of going where they think that the Federal Reserve is going to go. But it takes time. They have to look at all the data and they try to figure it out based upon everything that they're seeing. And this is what we call, this is the Federal Open Market Committee. That's what FOMC is, Federal Open Market Committee. They released their dot plot. And based upon what they're saying right now is for this year, we're going to finish off at 4.5%, which means there are still 2 more rate cuts for the rest of this year, probably one in November and one in December. And then next year in 2025, there are a total of 4 more rate cuts that will bring it down even further. And then we will get down into 2026, bring it down to 3.5. Then in 2026, they'll make their way down to 3. So they'll come down another 0.5%. This is based upon what they're seeing right now. Does that mean this is exactly where they're going to go? No, not at all. Because I could show you the dot plot from last June, and it wasn't nearly as aggressive as what we're seeing right here today, which means that as the economy unfolds and things change in the economy, that their forecast of where we're going to go totally changes, which is why interest rates bounce all over the place because things are constantly changing. Maybe the job market slows more than people thought. Maybe we add more jobs than people thought. So that will change the view of where the dots will be in the future, where Federal Reserve is going to be with their short-term federal funds rate. And then, of course, as the different data points come out, it will change what happens to interest rates instantly in anticipation of where they think the Fed's going to go based upon the data coming in. So where are we going from here? That's what everybody's asking me. Well, first I want to bring in our sponsor, and our sponsor is back. It's Alan Mack from Mack Financial Services, and he has a private banking rates for your clients. Clients can turn to Alan Mack, and he's going to help him out because he has a network of private and regional banks. He knows the best of the best in these banks. He's a luxury specialist with loan amounts up to whatever you pretty much need. And he shops for the lowest rate below market interest rates. He has unique offerings, debt to income ratios up to 50%, flexible underwriting. He has this program. There's a couple programs that he's highlighting. One of them is the 2-1 buy down. And that 2-1 buy down, when you do these buy downs, actually can get you down to the mid threes. And you can get sellers to pay concessions and pay for these buy downs. You get down to the mid 3% as a start rate. And this program, this 2-1 buy down that he has with this lender, is up to $2 million, and it's a primary or secondary home. And also has a credit union special that will do 90% mortgages up to $2 million. And he does 80%. He has this relationship with his credit union up to $5 million, 70% up to $10 million, and 65% up to $100 million. So he's got these great specials that are extremely popular right now. And he has experience. He's been doing this since 1988 with over 100 5-star reviews. He has unparalleled knowledge. And he just announced this, that he's a 2024 5-star Legends 10-year winner, as seen in the Fortune October-November 2024 issue. Just made this announcement. And so you can contact Alan Mack and let him get you the lowest rate with Mack Financial Services, 949-929-1091. That's 949-929-1091. Thank you, Alan, for your continued support. We appreciate it. Now back to the program. So where are we going from here? Well, first I want to tell you what the Fed said. They said, you know what? So we've done this recalibration, this new focus. That's why they're coming down. They're trying to get in front of the slowdown of this labor market, and they feel like that's why they came down to 0.5%. They're kind of getting in front of the slowdown so that we have this nice easing, and the labor market does not continue to slow from here. So this recalibration from the Cambridge Dictionary means a change in the way you do or think about something. So this kind of sounds like it's a shift in their overall thinking. And this is exactly what he said about that. He said, this recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving forward to a more neutral stance. Now, basically what he's saying in this is that, that there's a lot of strength still in the economy. There's a lot of strength still in the labor market. We're still adding quite a few jobs on a monthly basis, and inflation's coming down. We just want to make sure that we're not too restrictive, and inflation comes down below 2%, and the job market goes kaput, and the economy slows down, throws us into a recession. So we're getting ahead of all that, and as a result, don't worry yourself. Everybody should just stay calm. The economy is not breaking. We are not going into a recession. We are watching inflation come down nicely, and we're still adding those jobs that we talked about. Don't worry about it. We're coming in for a landing. We've been kind of cruising. The overall economy is still doing well. If you follow GDP numbers, GDP still looks really strong, and it's not like we're going into negative GDP. That soft landing is going to happen. And this is what everybody's intuitively thinking. This is what Wall Street's reaction was yesterday, well, really today. And this was their extra exuberance, because you know what? It really does sound like we're going to orchestrate that soft landing. And there's a lot of people that came out and said, soft landing, they got it. So, but in that, that the Fed is still carefully watching all the numbers. They're still going to be very, very data dependent. As a matter of fact, more data dependent than any time, even recently, they've been very data dependent. They're going to be watching this job market very, very carefully. They'll be looking at everything else, like where inflation's going. They'll be watching also how consumption's going, what are retail sales like, all that stuff. But what they really care about is the job market. That is fundamental. You get a crack in that job market, you're going to see rates really come down as a result. So we have to be very, very mindful. This 0.5% is not enough to totally stop the slowing of the jobs that has been the job market, which has been slowing. It's not there yet. They need to do more to make that happen, which is why they've said we're going to have to do more going forward. A couple more later this year, and then 4 more next year, and then even 2 off in 2026 land. So they're very, very data dependent as a result. Wall Street, like I said, yesterday just went nuts. Wall Street soared to a record as they had a record close date. Dow leapt 500 in a rate cut rally that swept the world. And you can find these articles all over the place. Everybody knows that that Wall Street just went nuts. And what now kind of happens is when the economy sounds really good, which is just from what the Federal Reserve said, everybody's is so excited about it. What ends up happening is stock market goes crazy, and then people don't have the same appetite. They want to go after stocks. They don't want long-term debt like mortgage-backed securities and treasury bonds, long-term treasury bonds. So as a result, you get the stock market going crazy, and the treasury bonds, 10-year treasuries and mortgage-backed securities slow down. But when the economy slows, stock markets don't do as well, and then everybody then instead going to the stock market, they go to not in stocks. They're not going to be, instead they're going to be looking at 10-year treasuries and mortgage-backed securities. So then they dump their money in that, and rates come down. So that's kind of the relationship that we see. We've had it in the past. It was kind of broken more recently, but that's the way it was in the past, and it's kind of resumed. So when the stock market's doing great, typically mortgage rates aren't going to do as well for the day. And when the stock market isn't doing as well and the economy is slowing down, mortgage rates will do better. Because that's what the Federal Reserve is going to do. When the economy slows, they're going to want to have lower rates to kind of like spice up the economy, and that's the fuel for the economy. If you have easier lending with lower rates, the economy will get a lot better. And there's another term that the Federal Reserve has used before, and it's not just recalibration. They've used other terms before, and another term they used was transitory. And we all learned that they were wrong on transitory. It wasn't. They knew they were wrong, but they took so long to react that it was a problem. So they're trying to come up with these terms that will kind of like calm the markets. And that's why they came up with transitory. They were wrong with that. They are done this recalibration. We will have to see. We'll have to see with the data. They'll be watching the data. And of course, we will be watching the data too. So from here, I'll be looking at it all the time. And where do I think rates are going to go? I actually think they're going to have a harder time slowing this engine down as much as they want, but at least they're going to be on top of it so that they will do the necessary rate cuts. But if we see some numbers, and there could definitely be some job numbers over the course of the coming months towards the end of the year, where you actually see that the job market isn't as robust. And if we see those job numbers that don't agree with the economy, and you'll see that the stock market will go down a little bit and interest rates will go down as well. And that's because the appetite for long-term issuance of 10-year treasuries and mortgage-backed securities will go up. So that's where we think things are going to go. We actually believe that things will continue to slow a little bit from here. And as a result, we'll have interest rates that come down a bit further. And then it's off to the races. That's going to help out the overall real estate market, which has just been frozen with these higher rates. And then we'll finally come below 6% for the first time since August of 2022. So if you like what you've seen, like this video and share it with others and subscribe to our channel. You can go to reportsonhousing.com. We have housing reports that dot all over SoCal for each of the various counties, as well as the Bay Area. We're also in Maricopa, Phoenix, Clark County, Vegas. And so that's where we're at right now. And the most recent report that came out is called A Frosty Autumn. A lot of the coastal counties receive this, and next week the other counties will receive it. It's a frosty autumn, and we kind of talk about what's kind of going on and how the market has continued to slow and various reasons for it so that people understand really what's going on. And you can subscribe. Go to reportsonhousing.com, utilize the coupon code RATES for a free month, and thank you very much for joining us. I hope you have a fantastic finish to this week, a fantastic weekend. And we'll keep you up to date as to what's going on in the housing arena, from rates to the overall housing market, with housing updates, all that good stuff. So have a great weekend, and we will see you on the other side.